increasing by 8.4%. The inflation forecast of the bank has been subject to a further upward revision. Inflation is now expected to remain outside the upper end of the target range for the whole of 2012 and to peak in the second quarter of 2012 at around 6.6% before declining gradually and returning to within the target range in the first quarter of 2013. Inflation is expected to measure 5.5% in the final quarter of 2013. The bank's forecast of core inflation, which excludes food, petrol and electricity, shows a moderately rising trend, with a peak of around 5.5% expected in the first two quarters of 2013. The main factor contributing to the upward revision of the forecast is the changed assumption relating to the exchange rate of the rand, which was partly offset by the downward adjustment to the global growth assumption. Inflation expectations, as reflected in the survey conducted by the Bureau for Economic Research at Stellenbosch University in the fourth quarter of 2011, have increased moderately, but have remained relatively anchored around the upper end of the inflation target range. Inflation is expected to average 6.1% in 2012, compared with 5.9% in the previous survey. Expectations for 2013 increased from 5.9% to 6%. All categories of respondents revised their forecasts moderately upwards for both years, except for business executives whose expectation for inflation in 2013 remained unchanged at 6.3%. The global outlook remains clouded by the worsening situation in the Eurozone, and growth forecasts for the region have generally been revised down amid widespread sovereign rating downgrades. It is now generally accepted that the Eurozone is likely to experience a recession in 2012, but the extent and duration is still uncertain. The increasingly fragile sentiment is exacerbated by the lack of resolution of the sovereign debt crisis and the consequent increase in sovereign debt yields, further fiscal austerity measures in the region, and the impact on the real economy of higher capital requirements for banks and consequent bank deleveraging. Tightened lending standards have also had cross-border implications for a number of emerging market economies, particularly in Eastern Europe and Latin America. Although the OECD leading indicators and global PMIs are trending downwards, the economic growth outcomes in Japan and the United States have been more favorable than was the case in mid-2011. The unemployment rate in the US has declined, and both consumption and investment expenditure have shown some signs of recovery, although downside risks from fiscal consolidation and the continued weakness in the housing market remain. Growth in emerging markets and developing countries, while still relatively favorable, is also expected to moderate somewhat, in part due to the contagion effects from the European crisis, as well as policies which have been aimed at curbing domestic demand pressures. Economic growth in China is also expected to slow, but a hard landing is not anticipated. Sub-Saharan Africa, which has become an increasingly important destination for South African exports, is expected to continue to grow at a rate in excess of 5%. Global inflation appears to be moderating, as weaker demand has contributed to declines in food and commodity prices. Oil prices, however, have been underpinned by risks to supply due to geopolitical factors. The rand exchange rate has continued to display a relatively high degree of volatility in response to erratic changes in global risk aversion. Since the previous meeting of the MPC, the rand has traded in a range between R7.93 and R8.60 to the US dollar, but for the past month the range has generally been between R8 and R8.20. Since the previous meeting, the rand is more or less unchanged against the dollar and appreciated by about 6% against the euro, reflecting the influence of the euro-dollar exchange rate on the domestic currency. On a trade-weighted basis, the rand appreciated by almost 3% over the same period. South Africa's experience with portfolio capital flows during 2011 was similar to the general emerging market experience of slowing bond inflows and net equity outflows. For the year as a whole, non-resident purchases of bonds amounted to 42 billion rand, while net sales of equities were to the value of 17 billion rand were recorded. The outlook for the rand exchange rate remains highly dependent on global risk appetite. While the rand remains vulnerable to global developments, it has been relatively stable in the past few weeks, and consensus forecasts reflect an expectation that the current levels will be sustained for a protracted period. But this is significantly dependent on global sentiment and developments. The outlook for domestic economic growth remains subdued. According to the bank's forecast, the annual real growth rate in 2011 is estimated to have been in the region of 3.1%, but the outlook for 2012 and 2013 has deteriorated relative to the previous forecasts, mainly due to a downward revision to the global growth assumption. Growth in 2012 is expected to average 2.8% compared with the 3.2% in the previous forecast, while the forecast for growth in 2013 has been revised down from 4.2% to 3.8%. This implies a further expected widening of the output gap during this period. Despite the less favorable outlook, some improvement is expected in the mining and manufacturing sectors, which both contracted in the second and third quarters of 2011. Although mining output contracted further in October, it rebounded on a month-on-month basis in November. However, the change in the 3 months to November compared to the previous 3 months showed a contraction of 0.7%. The manufacturing sector experienced positive growth in October and November, with the physical volume of manufacturing output increasing at a 3-month-on-3-month rate of 2.6%. Nevertheless, the sector is expected to remain under pressure. Following 4 consecutive months of increases, the Kagiso PMI declined to below the neutral level of 50 to 49.4 in December. The construction sector also remains subdued, notwithstanding an increase in the real value of building plans passed in November and a slight increase in the FNB Building Confidence Index in the fourth quarter. On the positive side, the sector could benefit from the continued but slow improvement in the growth of gross fixed capital formation, which increased at an annualized rate of 5.6% in the third quarter of 2011. According to the RMB-BR Business Confidence Index, business confidence remains relatively low, having declined marginally in the fourth quarter of 2011. Despite the weak economic performance in the third quarter, employment growth surprised on the upside. According to the Quarterly Employment Survey of Statistics South Africa, formal non-agricultural employment increased by 47,300 in the quarter and by 207,000 on year, with the bulk of the increases in the second and third quarters coming from the private sector. This trend is consistent with that observed in the Quarterly Labour Force Survey. However, the employment losses suffered during the recession have still not been recovered, and future employment prospects remain uncertain given the fragile economic outlook. Growth in consumption expenditure by households continues to be the main driver of growth in the economy, but growth rates remain moderate and are not expected to pose a risk to inflation. Real final consumption expenditure by households increased at an annualized rate of 3.7% in the third quarter of 2011, up from 3.3% in the previous quarter, but lower than the levels recorded in previous quarters. Retail sales grew at a year-on-year rate of 6.8% in November, while on a 3-month to 3-month basis, growth of 3.1% was recorded. According to the FNB-BR Consumer Confidence Index, consumer confidence increased marginally in the fourth quarter of 2011. Consumption expenditure continues to be constrained by relatively tight lending standards by banks, high levels of household debt, and consistently above average increases in a range of administered prices, which reduce the amount available for household discretionary expenditure. The gradual deleveraging by households has continued, with the ratio of household debt to disposable income declining further from 75.8% in the second quarter of 2011 to 75% in the third quarter, compared with a peak of 82.3% in 2009. The decline in the ratio, however, reflects the fact that disposable income is increasing at a faster rate than debt accumulation. Trends in credit extension have remained subdued and more or less unchanged since the previous MPC meeting, with year-on-year growth in banks' loans and advances to the private sector measuring 6% in both October and November. Mortgage advances remain relatively depressed, in line with the weak state of the housing market, and increased by 1.9% in November. The main drivers of credit extension in November were the 6% increase in installment sales credit and leasing finance, reflecting improved motor vehicle sales, and other loans and advances, which increased at a year-on-year rate of 12.6% in both October and November. This category was driven mainly by general loans, which include unsecured lending. The main pressures on inflation continue to emanate primarily from cost push pressures. Administered prices remain a concern in the inflation outlook. The price of electricity has been an important driver of inflation, and increases of 17.3% are assumed for both 2012 and 2013. However, the current NERSA determination ends in mid-2013, and subsequent price increases are yet to be determined. The case for further significant above-inflation increases is questionable. The determination of administered prices should not act as an inhibitor to growth and investment. International oil prices have been subject to conflicting pressures. Downside pressures have emanated from the weaker global growth environment, while upside pressures emanate from geopolitical factors, which have raised fears of possible supply disruptions. Nevertheless, the price of Brent crude oil has been surprisingly stable and, despite some volatility, is at similar levels to those prevailing at the time of the previous meeting of the MPC. Domestic petrol prices decreased by a cumulative 16 cents per litre since early November, but the current under-recovery suggests that a further increase can be expected in February. According to Andrew Levy Employment Publications, the overall average wage settlement rate in collective bargaining agreements amounts to 7.7% in the first 9 months of 2011, compared with 8.2% in 2010. However, there are indications that the downward trend in nominal remuneration may have reversed. According to Stats South Africa, growth in remuneration per worker increased by 8.6% in the third quarter of 2011, compared with the same quarter in 2010, up from 6.4% and 7.4% in the previous 2 quarters, respectively. Adjusting for declining labour productivity trends, this has resulted in nominal unit labour costs increasing from 5.2% in the first quarter to 8.3% in the third quarter of 2011. These developments could pose further upside risk to the inflation outlook. Food prices remain a major driver of inflation, influenced by both local and global factors. Domestic food prices have been negatively affected by the recent depreciation of the rand and a smaller than expected maize crop, which contributed to the doubling of domestic maize prices over the past year. Futures prices of maize suggest that some relief may be expected during the first half of 2012. Furthermore, global food prices have been declining, with the FAO Food Price Index falling by 11.3% in December 2011, compared to its most recent peak in February that year. Nevertheless, domestic food price inflation at the consumer level is expected to remain relatively high for some time. The MPC has reflected on the various risks to the inflation outlook and considers these risks to be fairly evenly balanced, notwithstanding the reality that the exchange rate remains a significant source of uncertainty. The main downside risk continues to emanate from global economic developments. The MPC remains of the view that inflation pressures are primarily of a cost-push nature, but is concerned that a persistent upward trend in inflation and prolonged breach of the inflation target could have an adverse effect on inflation expectations, which could reinforce the upward inflation dynamics. However, the MPC is also cognizant of the slowing domestic economy and feels that given the lack of demand pressures, monetary tightening at this stage would not be appropriate. At the same time, the nominal policy rate is at a long-term low and the real policy rate is slightly negative, indicating a monetary policy stance that is accommodative and supportive of the real economy. The MPC maintains a preference for a stable interest rate environment, given the conflicting pressures on monetary policy at this stage. However, the committee will continue to monitor domestic and global economic and financial developments and the risks to the outlook, and remains ready to act appropriately to ensure the attainment of the inflation target over the medium term while being supportive of the domestic economy. The Monetary Policy Committee has therefore decided to keep the repo rate unchanged at 5.5% per annum. Thank you, and I'm now able with my team to take any questions that you may have. Can I ask you, as always, just to identify yourselves? And we'll start with you, Miriam.
Thank you, Governor. Mariam Issa from Business Day. In the statement from the MPC, a fairly strong case is made for not for slowing the increases in administered prices, and you mentioned that the case for this is questionable, and the determination of administered prices should not inhibit growth and investment. Is there anything that the Reserve Bank can do about this? Is the Reserve Bank going to talk to the relevant people about this and try to slow the process of price increases?
In the direct sense, no. These are prices that are set by different bodies throughout. So if you looked at education or health, you've all got price-setting bodies. The fact that we draw this to the public attention as well as to the attention of those who are setting those prices is part of the discussion that we need to have about what is driving the inflation in this country and where these decisions lie. Obviously, there's ongoing interaction between ourselves and the different bodies over time during the year. It's not just that you meet them on an occasional basis. There's discussion between the teams that are involved in setting electricity prices and our research team to see the impact. But what we're raising here is that the pressures do come from setting, or some of the pressures, not all of them, but they come from administered prices, and that we raise specifically the question of Eskom in terms of the price setting. So yes, ongoing interaction with them, yes, indeed. Yes.
Good afternoon, Governor. It's Renee Volgra from Sunday Times. Governor, at the previous two MPC press conferences, after questions from the press corps, you said there was some discussion on a possible rate cut, although the final decision was a unanimous one. Was there again similar discussions on the possibility of a rate cut given the growth prospects and especially the global risks? And then the second thing I want to know is, what is the bank's position on the downgrade of our rating outlook by Fitch Ratings last week?
Just in terms of whether there was discussion about a rate cut, no. And I wouldn't divide it into, we're now discussing whether there should be a rate cut or there shouldn't be. We have a general discussion, we discuss it very vigorously throughout. So the question of posing, should there be a rate cut, was not an issue this time. It was a unanimous decision. And I want to re-emphasize this question, is that when you consider monetary policy, you actually have three decisions that you can make. You can raise, you can lower, and you can hold. And hold is an active decision. It's not a default position. It's a question of saying that at this point in time, we don't see sufficient reason to raise or sufficient reason to lower. And that given all of the uncertainties, we feel that creating a stable, predictable environment in which there's certainty looking forward to the best that you can have certainty in an extremely uncertain environment is the best approach at this moment, given the balance that there is for the country to be able to take decisions. So it is an active decision, not simply a question, oh, well, we're not sure whether we should raise or lower, so let's hold. That's not the approach taken. On the question of the bank's view of the rating agencies, look, the rating agencies, as you've seen, have actually had a pretty broad brushstroke at the moment. It seems to be something that there's been a New Year resolution about what they want to do. And South Africa has had an outlook change, not a rating change, but an outlook change from both Moody's and Fitch. And obviously we take account of what they're saying, the concerns that they're seeing, and it's up to us as South Africa and all of us in our different roles to address those matters. Obviously, in terms of the country rating, we have every confidence in our banking sector. It is very sound, but you will have an impact simply because banks cannot have a higher rating than the country rating. So we take note of what the issues are and what is being raised, and certainly would address to the best that we can the concerns that are being seen, and to ensure that we do what we can to minimize any impact. So we certainly take it seriously. Yes.
Good afternoon, Governor. Nompumelelo Siziba from Summit TV. Just wanted to ask you about the possibility of a Greek default. If Greece and the private sector bankers can't get their act together and come to a deal, and Greece does default, what sort of impact do you foresee this having on South Africa?
I think that it would be inappropriate for us to single out of Europe the impact of a Greek default on South Africa. I think the question, you've got a huge number of commentators around the world who are analyzing every single possible outcome of a Greek default, no default, or whatever the decisions are. Certainly it's a serious situation, but I think that when we're looking at it from South Africa, we would be looking at the impact of the Eurozone as a whole, because the first impact you would have of any activity in Greece that does not provide a stable outcome and a stable forward-looking will be on the Eurozone. So, and that's why if you looked at the statement we've made, we've expressed our concerns about the lack of resolution, or the slow resolution, slow pace of resolution, and in particular the slow pace of sovereign debt in the Eurozone. You've got to bear in mind that this is not a small event, whether they go into default or not. It's a very challenging environment for Europe, and we would watch it closely. But I don't think, as far as I'm aware, we don't have exposure to Greece at all. But that would be a very narrow look at what's happening. And we look at it as the Eurozone and the implications for the Eurozone, and certainly discuss all of those things. So for us, it would be the totality of implications for the Eurozone and then consequences for us, which we've set out. Will be for the rest, for the whole world, or there will be an impact. I think the plus that we're seeing, which is important, is that this great recession and its consequences, you've had a very synchronized downturn, the United States, Japan, the Eurozone, the UK. And what you're seeing, and I think that's what we're pointing to, without it being something that we're overconfident about at all. But what we're saying is that you're having the beginnings of a signal that the United States may be growing a little better, and it may be a little bit more. It's a very tentative situation. It is not something that we can, with any confidence, say this is sustainable. But for 2012, it looks better. And the importance of that is not just that it's the US that's growing, because it is a driver of global growth. It's that it's breaking that synchronized downturn where all the countries are going down together. So you've got to have somewhere where growth is beginning to pick up and helps other countries come out of it. And I think that's the importance of what's happening in Europe and the US at the moment. At the back.
Tsepo Moy, SABC News. When back on the issue of ratings, when Moody's revised South Africa's outlook, you indicated that you will try to engage them and find the reason behind their action. What I want to find out is, in your deliberation, what are some of the arguments that they raised, and how did those discussions go?
No, I don't think it's appropriate to discuss what Moody's raised. It's an ongoing interaction with us. They've put out very clearly in their document what they see and what their concerns are. So it's a question for South Africa to look at that and see how we address those challenges. And there is obviously, as we've said, from the country and from ourselves, ongoing interaction with Moody's around these issues. So, I don't think we would elaborate on what they've put in their note. They've set out very clearly their concerns. It's up to us to look at that and see how we tackle them. There was also a hand at the back there. If I missed somebody. Miriam?
Thank you. I've got two very closely related questions about the Rand. In the previous MPC statement, it was said that the Rand is likely to appreciate this year. I just wondered if the MPC still holds this view. And I noted that in the upward revision to the inflation profile, it was said that the main reason was the Rand's depreciation. And yet the statement says the Rand has actually appreciated between the last meeting and now. So I just wondered if you could, explain that apparent discrepancy that the rand is a bit firmer than the last meeting, and yet your inflation outlook has gone higher?
I think that if, for all of us in this room, and I'm going to ask my colleagues to address this as well, but for all of us in this room, I would defy you to tell us where the rand will be in a few days. So that in the forecasting model, we've looked at what an assumption would be about where the rand could go. And that's what we're saying, is that in that assumptions in the model, it looks at inflation being higher because of that assumption. What we're also saying is that the rand has retraced its steps over the last few weeks. And therefore, it's been trading at this level and may well have contributed or contribute. If it stays at those more appreciated levels, it would contribute to the inflation outcome being slightly moderated from what the forecast or the modeling says. Because the modeling is interpreting, it has put in where it was before. So it's not a discrepancy. It's two different things. It's what your assumption is in the model as a weaker currency and what the currency is currently trading at in the band that it is. But as we know, this is not something that any one of us can say that it'll be the same in the next few weeks. So obviously it has that outcome. So that's the questions there that I would address. But perhaps, colleagues, you'd also like to address the question of appreciating this year. I'm not sure that look, the issue around appreciation and depreciation needs to be taken account of also, in that the reasons why you've had huge capital inflows into emerging markets have not gone away. What you've had is a risk aversion which has seen a flight of capital across emerging markets into, and that's not, and advanced economies, because obviously there's been a huge flow out there, into what is primarily the dollar. In that sense, you know, the returns that you're going to get and the need for those entities that were investing in emerging markets to meet their liabilities has not gone. So at some point in time, our expectation is that that will turn. Now, what that timeline is, nobody knows. But the reasons for it occurring with all its problems have not gone away. But perhaps you'd like to add. Yeah. At the back.
Governor Gill.
Well, there we have it. No move. Time for an ad break, and when we come back, we're going to talk to our guests about the decision and especially the content of the speech.